Hello, and welcome back to Forex School from Pip Insight. This is the complete scalping course, the fast game, played properly. Scalping has the most seductive marketing in retail trading and some of the most unforgiving economics, so we're going to do this in an unusual order. The costs come first. Here's the roadmap. We'll define what scalping really is, and, honestly, who it does not suit. Then the cost problem, the mathematics of a 5-pip target against a 1-pip spread. We'll find the hours where scalps actually live, build the one-setup approach around a single repeatable pattern, and lay down the execution rules that keep fast trading survivable. Then we'll walk a full worked session, 3 scalps, narrated honestly, costs and all, before the honest chapter on why most scalpers lose. Everything here is education, not financial advice. Coffee poured? Let's begin. Let's define the game properly. A scalp is a trade measured in minutes, in, a handful of pips, out. Targets are typically 5 to 10 pips, stops even tighter, and frequency is high. A scalper might take more trades in a morning than a swing trader takes in a month. Because each win is tiny, nothing can be allowed to leak, entries, exits, and costs must all be exact. And that shapes who this suits. Anyone who can't give a screen 2 hours of unbroken attention, who hesitates on triggers, or who takes losses personally will find scalping punishes those traits faster than any other style. It isn't a beginner's shortcut, it's a specialist's discipline, precision work, at speed. Most courses hide the cost chapter at the very end. We're starting with it, because in scalping, costs decide who survives. Here's the arithmetic most scalping content skips. Suppose the spread on your pair is 1 pip, and your target is 5 pips. The moment your order fills, you're 1 pip down, you've surrendered 20% of your entire target before the market has moved at all. Now compare a swing trader aiming at 100 pips, the same 1 pip spread costs them 1%. Same broker, same quote, 20 times the burden, purely because the target is small. And frequency multiplies it. 40 scalps in a week means 40 pips paid in spread, a decent week's profit for many traders, handed over win or lose. That's why a scalper's break-even win rate is far higher than the raw numbers suggest. Let's watch the toll booth in action. The line mark chart entry sits at 127.10, and that's where this long idea triggers on the 3rd candle. But look at the thin red box, with a 1 pip spread, the actual fill is the ask, 127.11. Price grinds upward, candle by candle, and on the 7th bar it pushes through the line mark chart exit at 127.16, with the next candle stretching to 127.21. 6 pips on the chart. The account sees less, we bought at 11, and with the quote slipping a pip in the rush to leave, we sold at 15. For pips banked from a 6-pip move, a third of the winner gone to friction. If costs rule the game, the schedule follows directly. Spreads are tightest and follow through most reliable when volume is heaviest, and that means 2 windows. The London Open, from around 8 in the morning UK time, brings the first real flows of the European day. Then the overlap, early afternoon in the UK, when London and New York trade together, the deepest liquidity of the entire 24 hours. Outside those windows, the maths quietly rots. In the Asian drift the same pair can show double the spread with half the movement. And around scheduled releases, NFP, CPI, central bank decisions, spreads can blow out for minutes at a time. Scalpers stand aside, the toll booth has just tripled its prices. Here's what that calendar looks like on a chart. The first 8 candles are the tail of the Asian session, boxed for you, the whole band is 13 pips deep, and no single candle manages more than a few pips of progress. Fading edges in here means paying full spread for half a move. Then the marked candle, the London Open. It closes at 127.24, clearing the entire overnight range in 1 bar, and for candles later the chart is printing 127.48 on its way to 127.52. Movement arrives on schedule, and spreads tighten as volume floods in. This is the only environment where the 5-pip arithmetic from the last chapter actually works. Next, the strategy itself, and it's deliberately narrow. 1 setup, drilled until it's reflex. At scalping speed there is no time to deliberate, so the answer is to remove deliberation. Traders who scalp seriously pick a single repeatable pattern and trade only that. 2 classic candidates, the range edge fade, selling the top and buying the bottom of an established intraday range, and the momentum pullback on M15, joining a fresh impulse after its first shallow rest. One pattern means hundreds of repetitions, and repetitions buy you 2 things money can't: recognition that fires in a heartbeat, and a genuine sample from which to judge whether the edge survives costs. Write the rules: trigger, stop, target, so exactly that a stranger could trade them from the page. Let's watch both candidates work. Here's the range edge fade, candle by candle. The ceiling is established early, the 4th candle wicks to 127.41 and gets rejected, that prints our range high. Price then crosses the whole box, tags the floor at 127.01, and holds, confirming the range. Now the setup, the second approach. The 11th candle spikes into the fade zone at 127.42, and the next bar fails there, closing back down at 127.30. That close is the trigger, short at the arrow-marked entry, stop a couple of pips above the zone, target the middle of the range at 127.20. 1 candle later price trades straight through the target and the bracket banks it. Edge to middle, never greedy. And the alternative, the momentum pullback. 3 strong candles drive this market from 127.04 to a high of 127.36, a fresh impulse with real conviction. Then the rest, 3 small, overlapping candles drift back into the boxed pullback zone, bottoming at 127.19, a shallow retracement, less than half the leg. The trigger is the marked entry candle reclaiming the previous bar's high, in at 127.28, stop beneath the pullback at 127.17, target 127.45. The next candle breaks the impulse high at 36, that's the BOS tag, and the bar after closes on the target at 127.45. Risk 11 pips to make 17, momentum joined, not chased. Setups get the glory, but execution pays the bills. 3 rules keep the fast game survivable. Rule 1, bracket everything. The stop and the target go in with the entry, as one order, before emotion gets a vote. At this speed there is no time to decide anything after the fill, so every decision is made beforehand. Rule 2, never average down. Adding to a losing scalp converts a 5-pip mistake into a 50-pip disaster, and it is precisely how fast accounts die slowly. Rule 3, the 3-loss stop. 3 losers in a session and the session is over, no negotiation, no one more trade. Either the market isn't offering your pattern today, or you are no longer the calm trader who tested it, both are reasons to stand up. At 40 trades a week, the routine is the edge. Time to put it all together. 1 London morning, 3 scalps, every pip accounted for. A constructed London morning, built for education, with a range ceiling at 127.30 and a floor at 127 exactly. Trade 1, the 3rd candle wicks to 127.31 and stalls, and the arrow marked short fades it at 127.28, bracket in, stop at 33, target at 19. The very next candle drops straight through the target at the arrow marked cover, 9 pips gross, call it 8 after the spread. Trade 2, price crosses the range and tags the floor, and the arrow marked long buys the hold at 127.04. Then, nothing. 2 candles of chop, no bounce, so it scratched flat at the arrow marked scratch, 0 gross, minus 1 pip of costs. Running total, plus 7. Late morning, same range, trade 3. Price climbs back to the ceiling, and the 4th candle tags it at 127.31, the same picture that paid us an hour ago. The arrow marked short fades it again at 127.28, stop at 32. This time there is no rejection, the next candle pushes straight up and closes on the stop, out at 127.32, for pips gross, 5 with costs. And look what follows, the bar after drives to 127.38, the BOS tag confirms a genuine breakout, and the chart closes at 127.49. The fade was simply wrong, the stop did its job. The morning's ledger, +8, -1, -5, +2 pips, net of everything. That is what a decent scalping session honestly looks like. Discipline kept it positive, not brilliance. Now the chapter the marketing always leaves out, and the reason this course exists. Let's be straight. Regulators oblige brokers to publish the numbers, and they typically show around 70 to 80% of retail accounts losing money, and shorter holding periods generally correlate with worse outcomes, not better. The reason is structural, and you already know it. Costs scale with frequency, and so do mistakes. Speed amplifies both edge and error. A trader with a genuine, tested edge compounds it dozens of times a week. A trader with a leak, loose entries, moved stops, revenge trades, compounds that instead, at exactly the same rate. Add fatigue, because 2 hours of full attention is genuinely hard work, and the margin for sloppiness is zero. Scalping doesn't create edge. It magnifies whatever you bring to it. One more honest truth, your broker matters more here than anywhere else in trading. On a 100-pip swing trade, half a pip of extra spread is a rounding error. On a 5-pip scalp it's 10% of the target, and across 40 trades a week, that's 20 pips gone, silently. Slippage bites hardest in exactly the fast moment scalpers love. Requotes and delayed fills can turn a valid setup into a loser before the position even exists. Some brokers' terms actively discourage the style altogether. So audit before you commit. On a demo account, record the quoted price against the filled price, trade after trade, and measure your real cost of doing business. If the fills are poor, no setup on earth can save the maths. Let's bring the whole course together. Scalping is minutes-long holds, small targets and high frequency, a specialist's discipline, never a shortcut. Costs come first. A 1-pip spread taxes a 5-pip target by 20% on every single trade, win or lose, so the arithmetic is the strategy. Scalps live only in the liquid hours, the London Open and the London-New York overlap, and never around news. The approach is one written setup, a range edge fade or a momentum pullback, drilled through hundreds of repetitions until it's reflex. Execution is bracket orders, never averaging down, and 3 losses ending the session without negotiation. And the honest close, most scalpers lose. Speed magnifies whatever you bring, and broker execution quality is part of your edge, or the end of it. And that's the scalping course complete. You can now do something most aspiring scalpers never do, cost the game before playing it. You can judge whether the style suits your temperament, name the 2 windows where the maths actually works, and drill a single written setup with brackets, a scratch habit and a 3-loss stop. Your next step is obvious and unglamorous, a demo account, 1 setup, the London Open, and a spreadsheet recording quoted against filled prices, then let 100 repetitions tell you the truth. If this series is earning its place on your screen, subscribe so you don't miss the next course in the Forex School curriculum. And remember, everything in this series is education, not financial advice. No method is a promise of profit, and trading carries real risk of loss. Practice on a demo first. Until next time, happy studying.